Hello guys, welcome to the sixth session of this course where I'll be studying about gaps. Till now we have understood that a market has two things, POIs and liquidities, and inside POIs we have already studied about blocks such as order blocks, mitigation blocks and breaker blocks, but today we'll be studying about gaps, and inside gaps we'll be specifically studying these five things. First of all, we have got FVG, which is fair value gaps, and we have already learned a little bit about fair value gaps, but today again we'll be studying about them. Apart from that, we have BPR, which is called balanced price range. Then we have got BAG, which is called breakaway gap. Then we have got volume imbalance and gap imbalance. So now let's understand one by one what they are, and then we'll also see in the charts how to find this and also how to trade them. Okay, so now let's start with fair value gap. So fair value gap is very simple. You already know what a fair value gap is. Whenever we have got three candles like this and there is a gap between the first candle's high and the third candle's low. So let's mark this. This is the first candle's high, right? And this is the third candle's low. So the gap between these two, this gap is called a fair value gap. Okay, so this gap that you can see, this can be called as a fair value gap. Okay, so why it is created? As you know, fair value gaps are always created with order blocks, and you know the reason for order blocks, right? Because we have got major pending orders that institutions wants to take before continuing higher, because institutions cannot take all the orders in one single go, right? Because if they want to buy a certain amount of quantities, then they also need that same amount of sellers that are not always available in the market. So for that reason, what the institutions do is they leave their footprints on the market in the form of these massive candles, which are called fair value gaps. So what they will do is they will make sure that market comes down, taps into this zone, and then market continues higher. Okay, so just like order block has pending orders, similarly we'll see that market does not always tap into the order block. Rather, it will just tap into the fair value gap above the order block if you're looking for buying, and that market will start to move from there itself. So that means that their pending order was at this fair value gap itself rather than the order block, and that's why I keep telling you that we have to mark both the order block and the fair value gap as one single POI. So once market comes down, taps into the zone, we will be looking for an entry using confirmations in the lower time frame. Okay, so this is the concept of fair value gap, which is similar to an order block. Okay, so this is what a fair value gap is. Now this is for a bullish fair value gap. The similar thing will happen when market is bearish. So let's say market is dropping, and once again the candle color does not matter. The first candle color can be green, can be red, does not matter. The third candle color can be green, can be red, does not matter. What matters is that the first candle and the third candle, they're not in contact with each other. Okay, if that happens, then the middle candle where there will be the gap between these two candles, this gap will be called as the FVG or fair value gap. So this is for a bullish market. Similarly, for a bearish market, we will see a bearish fair value gap like this. Now in this case, I have drawn the last candle as a green candle. So in this case, this will be our first candle, this will be our second candle, and this will be the third candle because market is coming down. So we'll be considering this candle as the first candle. Okay, but while market is going up, we will be considering the first candle as this one, then this will be the second candle, and this will be the third one. Okay, so in this candle you can see that the first candle's low and the third candle's high, they are not in contact with each other. So once again, the gap between these two candles, this is going to be called as a fair value gap. Okay, so this will be our bearish fair value gap. So once market taps into this zone, we'll be looking for a sell opportunity from here, and we'll be targeting the last low, which will be our liquidity, right? So this is what a fair value gap is. It's very simple, and this is how you mark the fair value gaps, and you wait for market to tap into the fair value gaps, and then you look for an entry from there. Okay, Now let's say that there are multiple fair value gaps. So let's say that the market is pushing higher, it's in an uptrend, and we have got three fair value gaps like this. We have got the first fair value gap over here, we have got the second fair value gap over here, and the third fair value gap over here. So which fair value gap do we focus on? So like I've told you in the first class, I think that if there are multiple fair value gaps, then you'll be focusing either on the first one or on the last one. Okay, so these are the two fair value gaps that you have to focus on. The first fair value gap will be important. If market taps here and gives confirmation, you will take your entry from there and you'll be targeting the liquidity. But if market drops below the first fair value gap, in that case, you'll be focusing on the last fair value gap, and from there, you'll be making entry towards the direction of the trend, and once again, you'll be targeting the liquidity. Okay, so this is for multiple fair value gaps. Third thing is about the size of fair value gap. So this is very important. Now this is being considered for a bullish market. The same thing will be applied for a bearish market as well. So if the market is bullish and we have got this kind of three back-to-back green candles, let's say for example, once again the candle colors does not matter. The first candle high and the third candle low should not be in contact with each other. That's the only condition that matters. Now once we have got a fair value gap, let's say we have got this fair value gap, so let's mark it. Another example, and this is also a bullish market, and here we have got a fair value gap as well. So you can see here that in the first case we have got a bigger fair value gap, and in the second case we have got a smaller fair value gap as compared to the first case. So does that mean that the first fair value gap is more powerful than the second one? Then no, that's absolutely not the case. The size of the fair value gaps does not matter at all. Both the fair value gaps have the same kind of power to move the market to the upside once this fair value gap gets tapped into. So these fair value gap can move the market all the way to the last high, which will be our liquidity or the target. Similarly, this fair value gap can also move the market all the way up to the last high. Okay, so the size of the fair value gap does not matter. And this is for a bullish market. The same thing can be applied for a bearish market as well. The size of the fair value gap won't matter. If there is a fair value gap, then we'll be marking that fair value gap and we'll be looking for an entry from that fair value gap towards the direction of the trend. Okay, so I hope that is clear to you. Now this is all about fair value gaps that you have to know. And once again, fair value gap is the most common type of gap that you see in the market. Now let's show you some examples. So I'm considering the chart of GBP/USD because I've already seen multiple examples in gold, and today I'll also show you more examples in gold, but for specifically fair value gaps, I'm choosing GBP/USD. So this is the 1 hour chart in GBP/USD, and here you can see market started to push higher and market came down, tapped into this fair value gap, and from here market went up, right? So here we had multiple fair value gaps. We had this fair value gap as the first one. We had this as the last fair value gap, right? But market just tapped into the first fair value gap, and from here market pushed higher. Once again, market created a new fair value gap over here, tapped into it, and then market displaced higher to take out the last liquidity. Similarly, we can see there is another example over here where market created this fair value gap, then it taps into it, and after that market expands and targets the last liquidity, right? Now in this push to the upside, you can see that there were multiple fair value gaps. This was the first fair value gap. After that, we had the second fair value gap, and then we had the last fair value gap. So market tapped into the first fair value gap and displaced higher from this fair value gap itself. And that's why I told you when there are multiple fair value gaps, you have to focus on the first one. But if the first fair value gap is not able to push market to the upside, in that case, you'll be focusing on the last fair value gap. Okay, so keep this in mind. Now let's see some more examples. So here again, we can see that market has created another fair value gap, tapped into it, and then market pushed higher. Once again, market creates this fair value gap, taps into it, and then market pushes higher. Once again, now this is for a bearish market. So market drops, taps into this fair value gap, and from here market drops to the downside. Here again, we have a bearish example. Market comes down, taps into this massive fair value gap, and from here, market goes down and takes out the last low, right? So this is how fair value gap works. Make sure you mark them in your chart and see if market has reacted from those fair value gaps. If it did, make sure that you try to take an entry from those fair value gaps and see if you can actually catch an entry from those fair value gaps or not. Okay, so this is how you can mark the fair value gaps in your chart. Now, in all kinds of market, whether it is currency pairs like GBP USD, Euro USD, or commodities like gold, silver, fair value gaps are the most common type of gaps that you see in the market. So they are very, very important. Make sure you mark them on your charts and see if you can actually take entries from those fair value gaps or not. Now let's talk about the next type of gaps, which are BPR. So once again, let's go to GBP USD, and here I have got an example over here. Now in this example, once again, market came down, gave multiple fair value gaps, right? So in this case, we already know if there are multiple fair value gaps, we have to mark the first one and the last one, which will be this fair value gap. So in this case, market did not react from the first fair value gap. So you would be waiting for market to tap into the last fair value gap, right? And the order block. But you can see that market does not go all the way to this last fair value gap. Rather, it drops from this fair value gap. So why did it happen? It happened because we have a gap over here, which is actually the combination of two fair value gaps. So you can see that we have got this bearish fair value gap. Apart from that, we can also see that we have got this bullish fair value gap over here, right? So whenever there are two fair value gaps in front of each other, this zone becomes a very powerful zone, and this is called a BPR, which is a balanced price range. So in this case, you can mark the common overlapping zone between these two fair value gaps, and this becomes a very powerful zone now, because now we are not just talking about one single fair value gap, rather we have got two fair value gaps overlapping with each other, which makes this zone a very powerful zone to watch. So you can see that market tapped into this zone, and from here market strongly displaced to the downside all the way to the last low. So this is what a BPR is, which is the second type of gap which is in the market. Yes, we do not see them as much as fair value gaps, but whenever we see them, there are two fair value gaps in front of each other. That zone becomes a very, very strong zone for market to react from. So make sure that you go to the charts and mark BPR and see if market has actually reacted from these zones or not. Okay, so you can see this is what a BPR is. This is the example of a bullish BPR where we have got a bearish fair value gap over here. And just in front of this, we have got a bullish fair value gap. So we have to mark the common zone between these two fair value gaps, which is going to be this zone, right? So I'm going to remove this one and I'll be just marking this zone. So when market comes down and taps into this zone, we'll be looking for an entry from here using confirmation entry models, and we'll be targeting the last high. Similarly, we can look for a bearish BPR. We can see we have got this bullish fair value gap over here. And just in front of that, we have got a bearish fair value gap over here. So once again, we are just going to mark the common zone which overlaps with the two fair value gaps, and this is going to become our bearish BPR. So once market goes up and taps into this zone, we'll be looking for a sell opportunity from this zone using our confirmation entry models, and we'll be targeting the last low. Okay, so this is what a BPR is. It is more powerful than a single fair value gap because we have got two fair value gaps in front of each other, which makes this a much powerful POI than just a single fair value gap. Now let's talk about the third kind of gaps, which is BAG or breakaway gap. Okay, now what is a breakaway gap? It's very simple. So once again, we have got three back-to-back green candles and we have got this breakaway gap, right? So let's say that market comes down, taps into the fair value gap, and market starts to push higher. But what you will see is that from here, market should go all the way up to target the last high, right, which is our liquidity. But market fails to do so. Market will give a reaction from the fair value gap, But then what market will do is market will come down once again to tap the remaining fair value gap, and then market will go all the way up to target our liquidity. Now this specific kind of price action is mostly shown by Bitcoin. Let me show you some examples. So let's go to Bitcoin. Here you can see that I have already marked two examples. So this is the weekly chart in Bitcoin, and here you can see that we have got this back-to-back three candles, right? And the first candle and the third candle, they're not in contact with each other. So this gap between the first candle and the third candle, it becomes our fair value gap. So what market does is market comes down, taps into this fair value gap, and market gives a very strong reaction. So according to the structure, as much as we have learned that market should now go to the liquidity, right? But you can see what market does is, even though there was a massive reaction and market went very close to our liquidity, but market did not actually take the liquidity. Market dropped once again to fill the remaining fair value gap that it has left, and then market pushed higher to target the liquidity, right? So these remaining fair value gap is called breakaway gap. Okay, this is called breakaway gap, or in short form BAG. Okay, so this is what a breakaway gap is. Now let me show you another example. So this is another example in Bitcoin where market was bullish, and once again market has created multiple fair value gaps over here. So this was the first fair value gap, right? And you can see market came down, tapped into this fair value gap, and then market went all the way up and took out the liquidity. But after that, market could not continue higher. Market just swept the liquidity and market started to drop. Now you have to understand that even though the market started to drop after taking out the liquidity, the structure was still bullish, right? So that means that we'll be looking for buying opportunities. Now obviously this fair value gap has already been tested. So now we'll be focused on the last fair value gap, which is going to be this zone. So what market does is market comes down, taps into this fair value gap, and gives a massive reaction from here. But according to the structure, once it tapped into this POI, it should have gone all the way up to target this liquidity, right? But market fails to do so. What market does is, initially market taps into this fair value gap and market gives a strong displacement. But what market does is market comes down once again to test this remaining fair value gap, which now becomes our breakaway gap. So market comes down to tap it, and then market goes up to target this liquidity. So you see different kind of market behaves in different ways. Now breakaway gaps are filled mostly in Bitcoin, but if you go to gold and if you try to find this kind of price action in gold, you won't see this kind of breakaway gaps getting filled. So here you can see that we have come to the gold chart, and this is the weekly chart. So you can see that market has created this fair value gap, right? Market taps this and immediately market gets displaced to the last liquidity, right? It does not come all the way down to fill this remaining fair value gap, which becomes our breakaway gap. Similarly, here we can see that market has created another fair value gap, and market taps into this fair value gap, and then market displaces all the way up to target this liquidity, right? So once again, market does not come down to tap into this remaining fair value gap, which becomes our breakaway gap. So different market shows different kind of behaviors. So you have to understand which market shows what kind of behaviors. Now, if you are somebody who is looking to trade breakaway gaps in gold, you will be disappointed because market is not going to give you the opportunity to take your entry from the breakaway gaps. Market will just tap into the fair value gap and immediately get displaced from there, right? But if you try to trade Bitcoin, in that case, even if the fair value gap gets tapped into, you have to be very cautious that market can once again drop to tap into the remaining fair value gap, which now becomes a breakaway gap, right? So you have to monitor the price action in different charts because different chart behaves in different ways. Okay, so this is what a breakaway gap is. So if you trade crypto, then definitely this will be useful. But if you do not trade crypto, if you mainly trade metals like gold and silver, then you are going to get disappointed because market does not fill the breakaway gaps most of the time. Okay, so this is the third kind of gaps, which is called BAG or breakaway gap. Now this is for a bullish market. The exact opposite will happen for a bearish market. Now let's talk about the fourth kind of gap, which is called volume imbalance. So when you see this kind of two candle formation where there is a gap between the body of both the candles, but the wicks are in contact with each other, this kind of gap is called a volume imbalance. Volume imbalance is also one of the important POIs that we see in the market, but yes, we do not see them very often in the market, but whenever they form, they act as very important POIs. Okay, so now let me show you some examples. So this is the daily chart of gold, and here you can see I've already marked some volume imbalances in the chart. So this was a volume imbalance. You can see that this candle closed over here, but the next candle's opening was over here, right? But yes, the wicks of both the candles, they were touching each other. So this becomes an example of a volume imbalance. So we are going to mark the zone between the bodies of these two candles. And as you can see, when market tapped into this zone, market got displaced to the downside and market came all the way down to target our liquidity. Okay, now let's see another example. Here also we can see that this candle closed over here, but the next candle opened over here. But once again, the wicks of both the candles, they are in contact with each other. So we are going to mark the zone between the bodies of these two candles, and you can see that market went up all the way, tapped into this zone, and from here got displaced to the downside. Even though market could not drop all the way down to target this liquidity, still this was a good amount of drop that we saw in the market. Okay, so this is what a volume imbalance is. Now I will show you some more examples of volume imbalance, but before that, let's also understand the last kind of gap, which is gap imbalance. So here also you can see that there are two candles which are not in contact with each other, but in this case, not only their bodies are not in contact, but also their wicks are not in contact with each other. So this kind of imbalance is called a gap imbalance, right? So whenever we say that there is a gap up opening or a gap down opening, we see this kind of an imbalance in the market, which is called a gap imbalance. And they are also very, very important. But once again, they're not seen very often in the market, but whenever you see them in the market, make sure you mark these zones because the market will most of the time react from these POIs, okay? And one more thing that I want to tell you is that I think I've already told you in the first class is that order blocks, they are the most powerful, then comes imbalance, and after that comes FVG. Okay, so this is the hierarchy of POIs. Okay, so order blocks are the most important, then we'll be focusing on imbalance such as volume imbalance or gap imbalance, and then comes the fair value gap. Okay, so now let's see some examples of both gap imbalance and volume imbalance in the 1 hour chart in gold. So this is the 1 hour chart, and as you can see, I've already marked a couple of zones over here. So let's start from this one. So what is this? We can see that we have got a massive gap up opening in gold in the 1 hour time frame, and both these candles are not in contact with each other either by their bodies or by their wicks. So this is what is called a gap imbalance, and you can see that when market came down, tapped into this zone, the kind of reaction that it has shown was massive. So market taps into this zone and immediately gets displaced from here all the way to target the liquidity, right? Let's say some more examples. So once again, this is a case of a gap imbalance. Market creates this massive gap up opening, and then market breaks this zone to the downside. But when market breaks this zone to the downside, market comes up, taps into this exact zone, and market starts to drop from here. Now in this case, this gap imbalance becomes much more powerful. Why? Because in this case, there are two POIs that are in contact with each other. We have got this gap, and along with that, we have got this fair value gap, right? So this makes this zone a much powerful zone than just a single gap. So when market taps into this zone, you can see that immediately market gets displaced to the downside and market comes all the way down to target this liquidity, right? Now let's see some more examples. Once again, we can see that we have got a gap imbalance over here. So we can see when market came all the way down, market tapped into this gap imbalance and immediately gave a massive reaction from this zone and went all the way up to target this liquidity, right? So this is how a gap imbalance works. Okay, so make sure you mark these zones on your chart whenever you see them in the chart. Obviously, you are not going to see them every single day, but whenever you see them, mostly you see them whenever there is a geopolitical tension which arises towards the weekend, and when the market opens in the next week, that's when you see this kind of massive gap up opening or gap down opening, depending upon whether it's an escalation or not. Okay, so this is another example where we have got a gap imbalance, but in this case, market does not react from this zone and market drops all the way down. Now this is an example of a volume imbalance where these two candles, they're contact in each other with the wicks, but their bodies are not in contact. So this becomes an example of a volume imbalance. So what market does is market comes down, taps into the zone, and then market goes all the way up to target this liquidity. So these are very powerful zones. Obviously, you do not see them as much as fair value gaps, but whenever you see them, make sure that you mark the zones on your chart and you watch for an entry from these zones using confirmation entry models. Okay, so here we have got another example of volume imbalance where these two candles are once again not in contact with each other through their bodies, but their wicks are in contact, and you can see what happens is market goes up, taps into this zone, and from here gets immediately displaced to the downside. So you can look for a sell entry from this zone and target this liquidity. Okay, so this is another example which is very recent. You can see what market does is market creates this massive gap up opening. So this becomes our gap imbalance. And when market comes down, taps into this zone, you can see that market immediately gets displaced from here all the way to the upside to target this liquidity, right? So you can look for an entry from this zone and you can hold the trade all the way up to target the last high. So this is all about gaps. Now you have to go to the chart and make sure that you mark all these gaps in your chart and see whether you can actually take your entries from these gaps or not using the confirmation models that we have learned. Okay, so that's all about gaps. In the next class, we'll be studying about liquidity.